and then studying part-time. So thank you for making the time to join this class, and I hope it will be beneficial. Just a few housekeeping rules before we get started. I would ask that you all please keep your mics muted. I won't put on my camera. I'll put it on for a second just to show you a face to the name, and I'll put it off because I do appreciate your data. And then I would ask that we please just all keep ourselves muted until we have a question, then raise your hand kindly, or if there's silence, please unmute yourself and just ask away. If we see that there are too many questions, we might finish one section and then continue with the questions later. But in general, please just ask questions as we go along, because sometimes it's beneficial for me to try and answer this as we go through. Today's session will be on inventory. It is a bit of a complex topic, especially for any individuals that don't have an accounting background per se. Mostly I will be referring to the study guide. I will share my screen with all of you, and we will be doing one or two just snippets on an Excel, which is also basically from the study guide. So without further ado, I will share my screen, as I know you are all very busy people. So you might ask why, as an attorney or studying to be an attorney or a career in law, why would you have to have any knowledge of inventory? Because attorneys don't per se hold inventory on hand or have cost of sales, other than maybe a minor thing if they've got some cool drink or a vending machine in the front of the office. But the reason to put it in context that many law practitioners need basically some understanding or knowledge of inventory is to help your clients. And some of the examples are shown on page 3. Perhaps before I continue, I just want to make sure that everybody can indeed see my screen. Yes? Okay. So on page 3 of Learning Unit 3, it mentions that, you might have clients that come to you that hold inventory, and you might have to assist them in drawing up contracts for when they maybe sell a business as a going concern, so the business as is to continue in future. You might also have remedies for breach of contract where inventory is applicable. For example, specific supplier maybe purchased a bunch of inventory from a supplier, and there were faults, or the quality was not great, or whatever the case may be. There can be many examples. And then legality regarding insurance claims. So I think that will also be quite a sensitive topic within the law practitioner environment, and quite valid. Then we've got our inventory cycle. So before we get to that, I will just also show you an Excel file, because I just want us to take one step back before we start with inventory, or focus really on inventory further. I just want us to take a step back into your knowledge that I'm going to presume you already have from working through Learning Unit 2, but just as a refresher, I guess, to try and just explain a little bit how the double entry system works, and to make sure that everybody has at least a basic understanding of that. So the screen that I'm sharing now is from Learning Unit 2 in your study guide, and that explains the double entry system, right? And in a nutshell, this is the foundation of all accounting equations, of any accounting that you will ever do. This is very, very important. And I feel that if you've got this understanding correct, everything else can be taught, can be learned, can be, yeah, even if it's very complex, if we always break it down to this double entry system, everything makes a lot more sense. So total debits in your transaction, in any transaction, must always equal total credits. And to keep it quite simple, if we've got basically a general ledger T account, it means that anything on your debit side, if you've got a transaction, if you enter something on the debit side of any account, somewhere in your accounting books, you must enter the same amount as a credit. The credit could perhaps be split between two different transactions. That doesn't matter. But for one specific transaction, whatever you debit somewhere, you must credit somewhere. And here it just explains to you the debits are on the left of your general ledger account and credits are on your right. And your equation must always balance. There are very good examples in your compulsory reading of Learning Unit 2 in case you want to refresh this knowledge and just make sure that you've got a good foundation. But an easy way for me to always remember, even to this day, when I'm doing any transaction or thinking of anything, is to remember the simple phrase that for assets and expenses, assets being bank, trade debtors, um, property, plant, and equipment, for example, your vehicles, and expenses. So any expense that you have for those two specific account categories, if you ever want to increase those accounts, I always remember that Dave takes, he increases it, and Cassie gives. So she decreases it. And similarly, the opposite is true if we think of liabilities being your creditors, any loans you have, and income. Do we have a question, or is it just somebody not muted? I will mute you. Okay, thanks. So we have similarly, if we've got liabilities or income, it will be the opposite, right? So there, the debit decreases and the credit increases. And if we've got the basis of this and this understanding, then I think everything else makes a lot of sense. Right, if there's any questions, please do pop them in the chat or put up your hand and I will gladly try and assist. So then if we look at the two inventory systems that we'll be sort of handling in our learning unit model, we've got our perpetual inventory system and our periodic inventory system. And the words in itself can probably be a bit daunting. What do they mean? What is the periodic inventory system? What is the perpetual inventory system? And in your study guide, the study guide, I must say, I think is really very, very good. And in the past few years that I've been an e-tutor, I feel that the study guide this year is exceptionally good. Not just showing theory, cycles, diagrams, but also examples. So I can't emphasize enough that although it's very, very good and beneficial to attend classes, it's also very, very important to work through the study material, especially examples, to make sure that your understanding is of a high standard. So back to the two different inventory systems. We've got our periodic inventory system, and the periodic inventory system does keep, it does not keep continuous up-to-date records, whereas our perpetual inventory system keeps continuous records. At any point in time on a perpetual inventory system, they are able to tell you exactly how much stock is on hand. So if we look at a supermarket, for example, like Checkers or Pick n Pay or Woolworths, they generally have a perpetual inventory system. And especially now the apps and the delivery becoming so, what can I say, popular, it's very important for them to have a good perpetual inventory system, because when a client orders or places an online order, it's very, very important for them to know whether stock is actually on hand. Whereas if it's not, like a supermarket, if it's maybe a smaller convention store or a tuck shop, they might not want to invest and know all of their inventory system continuously. They find out their inventory when they do inventory counts on a periodic time. It might be whatever suits them. Could be annually, could be monthly, could be weekly. Um, so then if we go further down into the differences between the two, for the periodic one, the entity will only have accurate records periodically. So once they do a stock take, they will actually know how much stock is at hand. You might say, why won't they know their stock accurately if they know how much stock was sold, how much stock was purchased? But there can always be a bit of discrepancies when we've got inventory. You might have some inventory spillage, you might have some stealing, deficit, products might have fault with. So it is important on the periodic system to always do your stock counts to verify your inventory balance. For your perpetual inventory system, as I said, this one is continuous. So it's normally a computerized accounting system where each item of inventory is linked to an electronic accounting record, and this creates a perpetual system. For the periodic inventory system, the records will be accurate once the journals are processed to take into account the stock take. So only at that point in time, once a stock take has been performed, given at whatever frequency the entity needs. After that, they will do their journals and they will know what their cost of sales is and what their stock is. Whereas for the perpetual inventory systems, products that have barcodes are automatically recorded as having been sold at tills in the supermarket when they are swiped. Yeah, sorry, there's a question, right? Yeah, so a periodic inventory system is any store that doesn't require, sorry, the question, in case everybody doesn't have it, is for an example of a periodic inventory system. For the perpetual one, we've now got a good example of grocery stores. But for a periodic one, it might be a tuck shop, for example, at a school. Somebody just selling some snacks to the children. It might be a car garage that has got different parts, that also has some parts in reception, maybe that sells, for example, spark plugs, those types of things. But it really depends on the entity. A perpetual inventory system is quite expensive. So normally you would find that your bigger places have got your perpetual inventory systems, and the periodic inventory system is normally used for smaller businesses, or if it's not important for them to really know how much inventory they have at hand. Another example might be, for example, a occupational therapist or a chiropractor. They sorry, I'll answer the next question now. Their main business is delivering a service, right? And if they sell some products at reception, for example, maybe pillows at a chiropractor or at an occupational therapist, they might sell some educational toys. Those are a byproduct, and most likely they're not going to have a perpetual inventory system to account for that inventory the whole time. They are most likely just going to have stock takes. Does that answer your question, Caitlin? No? Yes? Yes? Okay. And then Penny, the journal entries we are going to get to in a little while. So I just ask you to be a bit patient, but those are very important. We will definitely get to those. And then you've got, as your final point on this schematic diagram, your markup on costs. So cost of sales is the cost of goods sold over the period, and the markup percentage is the gross profit percentage of the cost price. In layman's terms, it basically determines what your profit is, what you've made after you've looked at what you've sold and what you've purchased. But we'll also get into that in a bit more. in a bit more detail. I'm just going to take you back to the Excel because one of the other very important parts of the differences between a periodic inventory system and a perpetual inventory system is that the periodic inventory system uses a purchaser's account, whereas the perpetual inventory system only has an inventory account in which it accounts for its cost of sales as well as any stock purchased. So to remember that, or sort of remember when there is a purchaser's account, what I like to do is I like to think of, if we look at this periodic systems like this. So periodic, if we look at the word, it's got a P, R, and a C in it. And a purchaser's account also has a P, R, and a C in it. The perpetual inventory system is missing the C. So it's an easy way for me to try and remember it. Not sure if it will work for everybody else, but if you're wanting to understand, the periodic system has got a purchaser's account and the perpetual inventory system has got a normal inventory account, no purchaser's account. And as we've said before, the periodic one, for each period, periodically, the stock is confirmed, and for the perpetual, they know it all the time. The stock is always confirmed. Right. So then if we look at the schematic representations of the periodic inventory system and the perpetual inventory system, which is also in your study guide, I'm going to take you through this, but I'm not going to take us through these journal entries here. We will work through example 3.1 and 3.3 respectively, as it basically takes whatever is in this but just shows it maybe in a little bit of better way that won't confuse you, because it's a bit difficult to completely comprehend this example if you haven't yet understood exactly how the two systems work. So what I'm going to take from these diagrams is basically our advantages, disadvantages, the steps, but then we will do our separate example. So for the periodic inventory system, again, it's basically reiterating what we said, but just putting a bit more context to it. So the inventory account is updated at regular intervals after completing stock take. The advantages to the system is it's easy to maintain, it's cost efficient, right? So we said generally for services industries or smaller entities, this is the way they'll go. The disadvantages of this one is your lack of accurate, real-time inventory information. And this could lead to inefficient management of inventory. What that means is, in the example of the chiropractor, for example, if they have special pillows or massage ointments that people could use, if they don't have a regular stock take, they might find that they no longer have stock on hand sufficiently until it's run out because they don't have that continuous inventory counting. There's also little control over this type of system because the inventory is there, but it's not controlled on a system the whole time. And there's delayed results because you can only know your true effect of how much your inventory costs, how much is at hand until you've got a count. So as with all inventories and all basically balance sheet accounts, we always have our closing balance of the prior year as our opening balance of this year. Then, as with any assets or anything in life really in your home, you have, for example, some, say, apples on your counter, and when you go to the store and you buy more apples, you are purchasing and you're making your apples more. And then when you consume some of the apples with your household, that's basically selling your goods and you are decreasing your stock of apples. And then at the end, you have to determine how many apples you have left on your counter. And that's basically your stock take, you will count the apples because there might have been a rotten apple, or one apple might have, I don't know, landed up somewhere where it shouldn't have. And then at the end, you will only know what your physical apple count is. It's a very layman way of explaining that, but that is the crux of it, right? What is important of the periodic inventory system, though, and the cost of sales is this at the bottom, right? So, very important. You have your opening inventory, you have your purchases, right? So the apples you purchased. You have your sales returns. So maybe you purchased some apples from a supermarket and you returned it to them. So you no longer have those apples. And then you've got your purchases returns. Oh, sorry, your purchases returns would be if you return some apples there. And then you've got sales, right? Where people maybe purchased apples from you, but they brought them back to you, making your inventory more again. And then you've got your closing inventory, your stock take. And if you've got your opening inventory, you add your purchases, making it more. You add your sales returns, so things that people have bought but brought you back, making your stock more. You minus any purchases that you have purchased but returned to the shop, so you gave it back to whomever you got it from, and you minus how much ever inventory you've got left when you do your stock take. That amount is your cost of sales. This is something you will have to learn. It's important to understand this. It's something that write it down somewhere, repeat it to yourself, but it does make sense logically for me in any case, if you break it down to say, you've got your opening inventory, what's there, you add your purchases, whatever you purchased, you add whatever somebody purchased from you and returned to you, and you decrease any of the purchases that you've given back to somebody else. And then you also decrease it with your closing inventory, whatever your stock take value is. That's your cost of sales. We will get into the journals. Don't worry about that. We will definitely get into the journals. So we are going to work through this example here, which is example 3.1, which sort of breaks down just exactly what we said now. It's important to understand that VAT is not included at all in these examples. It's just keeping it very simple in terms of what are our transactions, how do we account for our inventory. So if we look at this example, and it says a business started the financial year with 20,000 inventory at hand, right? So that is that example exactly here for us. And here's our periodic inventory system, has got a purchases account, as we mentioned. And now we'll be looking at these journal entries together. So it says that a business started the financial year with 20,000 inventory on hand, meaning that the balance of the inventory account was 20,000, right? That it started with. So that was the A. It's a given. It's from the prior year records. It's just a carrying forward balance. Then inventory of 10,000 Rand was purchased by the business for cash. Okay, so because this is the periodic inventory system, we don't add the purchases here to the inventory account. Later, when we look at the perpetual inventory system, you will see we don't have a purchases account and we add purchases to the inventory account. But first, back to our periodic example. So when we purchase any inventory with our periodic system, we work with the purchases account. So here is our 10,000 cash purchase of inventory. So we are debiting that, right? Then we are saying we also have purchased 15,000 of inventory on credit. So not on cash. As a creditor, we don't pay them now. We pay them later, but we already received the inventory now, so it is our stock. So we add that. We've got our two purchases together. Right. And as I said before, if we, for a double entry system, for every debit, there should be a credit. So when we had our opening balance, those are the balances brought forward. That's also technically a debit and a credit. But when we start purchasing our inventory, right? So inventory is purchased 10,000 Rand for cash. So we debited our purchase account. We made that more, right? With 10,000 Rand. And we purchased cash. So that's our bank balance, right? So our bank would always have an opening balance of whatever amount. And then if you purchase something, because bank is an asset, going back here, we debit, increase it, credit, decrease it. So if we are decreasing our bank with the 10,000 because we purchased inventory, we'll be crediting our bank and we are debiting our purchases. Right, that is the first part. The second part, we said we purchased inventory 15,000 on credit, right? So not cash. So if we look at our creditors, here's our trade and other payables. We will pay them not now, we pay them later, but we do have our inventory now. So we increased our purchases because this is a periodic inventory system with the 15,000. And we made our liability, because a trade and other payable is a liability, we make it more on the credit side. Again, here, liabilities increase on the credit side. So for every debit, we have a credit. So we are following our double entry principle thus far. Then if we look at number 4, inventory of 22,000 was sold for cash, right? So now we sold 22,000 for cash. So the easy part of that is that our cash balance would increase, right? With 22,000. Why is it increasing? Dave takes, increases. This is an asset, increases on the debit side. So we increased that part, but we also had a sale of the same amount. And so we also increase our sales because sales is an income, and income and liabilities increase on the credit side. We add our credit there. So we have increased our sales, there's our credit, and we have increased our cash. Here's our debit. Again, we've got a debit and a credit. Then, okay, Penny, do you want me to repeat something, Penny? Or you're okay up to where we are? From number 2. Okay. So, okay, right. So let's try again from number 2. So number 2 you got? I can do number 3 or number 2 repeats. If you could just indicate in the chat, please. Number 2. Okay. Okay, so we can try once more. So basically, I think everybody got number 1. Okay. Okay, good. So everybody, I think, got number 1. So we've got inventory at hand, right? Being our balance. Then we'll take it back again to number 2. So here they say that inventory was purchased for 10,000 Rand for cash. So we made our inventory balance more by 10,000 Rand and we paid cash for it. Okay, so we've got our purchases account because this is a periodic inventory system, and we add our 10,000 Rand there because we increased our inventory with 10,000 Rand. But how did we pay for the inventory? We paid by cash. And to understand why we are crediting cash and why we are debiting purchases, we have to go back to the double entry system, right? So for assets, which is cash, it increases on the debit side and it decreases on the credit side. So if we paid for something from bank, we are decreasing our cash. So we would expect to credit it. And that's what we did here. We credit our bank. And because purchases is basically an expense, we said that expenses increase on the debit side. So if we purchased inventory by decreasing our cash, making it less, we will be increasing our purchases on the debit side, making it more. And because we've got these two entries, we are following our double entry principle. We have a debit and we have a credit. Is number 2 clear now? If I could just have a heads thumbs up or something in the comment. Okay, 1 thumbs up, thanks. Heart, take that as a good. Okay, great. Then we go to number 3, which is very similar, although this time we still made our purchases, our inventory more, but we didn't pay for it using cash. We paid for it on credit. It's a, we've got an account with a specific supplier. Yes, Sydney, that's what I'm doing, right? So I'm highlighting as we go along. Okay. Then inventory of 15,000 was purchased by the business on credit. So we said if we are increasing an expense, we are debiting it. And here we are increasing our purchases with the amount on credit, right? So we're debiting our purchases, similar to what we did when we purchased the inventory for cash, but now we are just purchasing it for credit. If we debit somewhere, we also need to credit somewhere. So we aren't going to credit cash again because we didn't purchase it via cash, but we did purchase it via an account on credit. So we are increasing our creditors on the credit side as per this double entry system. You increase your creditors or your liability on the credit side. So when we have finished this, our inventory is now basically that we've purchased for the year is 25,000, and we've respectively decreased our cash with that amount and increased our payable with that amount. Is that all clear for everyone as well? If you can just give me a thumbs up. Not clear? Okay, thanks for the thumbs up. And then for Ash, yes, because this is the periodic inventory system, it's one of the main differences between the two inventory systems. We use the purchases account. As explained before, the periodic and the word purchases both have got P, R, and C in them. And that's an easy way to remember that for the periodic system, we use the purchases account. Whereas for the perpetual inventory system, we can hopefully get to that example in a little bit. When we purchase inventory, we debit the inventory account directly. So that's correct what you are saying. Okay, you understand. Okay, great. Fantastic. Then we can go to number 4. So inventory of 22,000 was sold by the business for cash. Okay, so now we've got a sale. So we've got our purchases, we have that in our purchases account, but now we've sold some of our inventory, right? And because this is not the perpetual inventory system, we don't automatically credit our inventory, making it less. What we do is we go to our sales, we make our sales more, right? Because we've sold some inventory. And if we go to our double entry system, our income, which is a sale, increases on the credit side. Hence, we are increasing our sales with the 22,000. Right. And if we sell something for cash and you are a store owner, once you get the cash, that cash is basically your bank, right? So we are increasing our bank with the amount of sales that we got because bank is an asset. It increases on the debit side. We all good with number 4? Thanks. Okay. Then for number 5, inventory of 26,000 was sold by the business on credit. So again, we've got a sale. So we increase our sales account with the same amount, 26,000, but this time it's not sold on cash, it's sold on credit. Somebody has purchased the inventory from us, but they won't pay us now. They're going to pay us later, but it's an asset for us because it's a debtor, right? That cash belongs to us eventually. So we've got our debtors balance or our trade and other receivables control account, and there we are increasing that. It's an asset. It's increasing, the same as cash. Increases on the debit side, and that is also what we say here. Repeat number 4. Okay. Right. Okay. We can repeat number 4 and then we can come back to number 5. So for number 4, we are looking at inventory that was sold, right? Making our inventory less and giving us a sale, either on cash or on credit. So if we have inventory of 22,000 and it was sold by the business for cash, what we would do is we increase our sales account, right, which is the income account. It increases on the credit side. We increase that with the 22,000, showing that that's an income. And we also increase our bank or our cash with the same amount because we sold it for cash. So they paid us the money immediately when they purchased the goods. Does number 4 make sense now? Specifically asking the person who typed in the chat to repeat it, if they can just confirm. Okay. Thanks, Ash, for confirming. If I don't hear anything else, I presume that one is clear. Then we move on to, sorry, please repeat number 4 again. Can you maybe just explain what part is not clear? Then I can, because I'm not sure how to repeat it again without explaining something specific. So why are we putting money on both sides? I can understand why you think that's money, right? So money in general, though, is only the cash that we get in, right? So if somebody pays you, if you go to a store yourself, if you swipe your card or you pay with cash, you're giving that cash to the company, right? You're making their cash more. However, that company also needs to show that they are earning an income. So they've made a sale to you, right? So if you go buy a bread wherever at a store, so if you go buy a bread wherever at a store, then you missed number 4, right? So we're doing number 4. The recording will also be ready though afterwards. I'm just cautious of the time. So I'm going to try explain number 4 as per the question in the group and then go on to number 5. but then we'll have to continue because we're already 40 minutes into the call, but the recording will definitely be shared afterwards. So you can maybe just make a note that around 40 minutes, that's when you have to rewatch. Okay. But it is a good question to ask, why are we putting money on both sides, credit and debit, right? So the cash is our money, but the sales isn't really our money. The sales is just accounting for that we've made a sale, that we've sold something. So if you think of having your own store and you maybe bake cakes for different people, when you sell a cake, you want to know you've sold the cake for 500 Rand, right? And if somebody pays you for that cake, that 500 Rand is yours, right? So you've made a sale for that cake, but what's important, and that's what we get to later in this example, is that cake, that 500 Rand isn't your full amount that you've made. Anything that you purchased, any expenses that you incurred to make that cake, that needs to be deducted from the amount you received, and the net of that is your profit. So sales isn't your bank, isn't cash, but cash is your cash, right? Um, I'm not sure if that helps you a little bit, but that is why we are crediting sales, because sales is an income account, and as per the double entry system, income increases on the credit side. Whereas bank, which is your cash and the asset, so if you've got sold something on credit, right, to a debtor, somebody who will pay you later, you increase your trade debtors on the debit side. And if you've received cash, you increase your cash on the debit side. So both are increased on the debit side. Okay, I'm going to try once more to do number 5, and then hopefully we can also finalize this example. So for number 5, we said that now we've sold inventory 26,000, but on credit, not on cash. So we aren't touching our cash account here, but we are increasing our creditors account. Our debtors account. We have sold purchases, sorry. We have sold inventory. We haven't bought inventory. When we purchase inventory on credit, we have a liability to pay that inventory, right? So when we purchased our inventory on credit, we have to pay that inventory. It becomes a liability, a debt for us. But when we sell our inventory for 26,000 Rand on credit, we are increasing our assets, making our debtors balance more. These people have bought goods from us, but they're not paying us now. They're paying us later. So we are showing them as a debtor, increasing our assets, same as a cash, it increases our assets on the debit side. Then at the end of the financial year, an inventory count was performed, and inventory at a cost price to the value of 40,000 was counted. Therefore, at the end of the financial year, the following adjustments are processed, right? So what do we have to do? When we calculate our cost of sales at the end of the year, and this is in also in your study guide, right? The different steps on how to calculate cost of sales. But this is just to show you here in a basically journal way how to do it. So if we just scroll back, it says at the end of the financial year, we have performed and there's inventory left of 40,000, right? So we've got inventory of 40,000 here, inventory stock take 40,000. But in this cost of sales account, we also have to show our inventory balance at the beginning of the year, right? So we have to clear our opening inventory amount as the 20,000 at the beginning of the year. This is where it becomes a little bit complex. And we have to clear our purchases account. So what it says is we have to clear our inventory account, right? So what did we have in our inventory account? We had our opening inventory from the prior year. And then we've got our inventory on the stock take. So we put in this journal here, 40,000 was counted on the stock take. We add it to our inventory account, and we also, the other entry of that goes to our cost of sales account, 40,000, right? Then we have inventory opening balance of the 20,000. So in our cost of sales account, we always have our inventory balance of our 20,000, which is what we sort of went through here. We've got our opening inventory plus our purchases minus our sales minus our purchase returns minus our closing inventory gives us our cost of sales. So this is in a nutshell what we are trying to do here. So then we bring our purchases here. So any purchases for the year that we had, which is in this account, we net off against the cost of sales account. Right, so maybe let's make this gray. If there was more amount in here, it could be a different amount, but the full amount we take out so that the balance here is 0. Do we have an inventory account in periodic? No, we don't have an inventory account in the periodic system. Well, we do have an inventory account in the periodic system. It's here, but it's not adjusted when we add purchases and when we do sales. It's only adjusted in the step that we're trying to do now to get you your end of year balance and your cost of sales amount, penny. So there is an inventory account, but it's treated differently than in the perpetual inventory system. So to go back to how we determine in our periodic inventory system what our, you're welcome, what our closing balance is and what our cost of sales is, we have to follow those steps. So we make purchases, whatever we purchase during the year, we net that off against our cost of sales account, right? And we have our inventory opening balance, which comes from our inventory account. Then we have the amount of the inventory stock take that was done, which is the 40,000. Take that to inventory and here, and then whatever is our balancing amount is our cost of sales, which makes it it's not easy to understand it just from one example. You'll have to do a few examples to really get it sort of covered, but you will just need to understand that we've got a formula to get to our cost of sales. So you've got your opening inventory, which is what we've got here in our cost of sales account. We brought in our opening inventory from our inventory account. Then we add our purchases. Yeah, you'll see now where the balancing amount comes from. So then we add our purchases. So that's just netting off whatever's in our purchases account here. And if we had purchases return, we would add that. We don't have that in this example, but we must then subtract our closing inventory balance from our stock take. That's what we do here. We subtract the inventory balance. And then the balancing is, so if you add up this side, it's 45,000. And before you have this balancing amount there, you only have 40,000 from your inventory stock take. And so the difference is your balancing amount, and that becomes your cost of sales. I know it's a little bit a lot to take in, but if you understand the principle and you apply that, then hopefully when you do more and more examples in the study guide, once you've got the basics under control, I believe the rest fall into place. Okay. In the exams, do they tell you which inventory system you're working with, or do you have to figure it out? Antoinette, please correct me if I'm wrong, but no, they will tell you definitely which inventory system a question is based on. Right,
Yes, Lynn-Marie,
okay.
we will definitely do.
Okay. Okay, great. So Caitlin, good. Then hopefully we're good. I think we're gonna start on the perpetual example. because this is, whilst this is fresh in your mind, it's easier to try do both examples now. Antoinette, this session is scheduled until 11:30, right? Also for the students?
Yes, for
Yeah, okay.
half
Half past
past
11.
11, yes.
Okay, then I think we try continue and see how far we get with the perpetual inventory example. Right. Thank you for confirming. So for the perpetual inventory example, it's again from your study guide, but it's using example 3.3. And the reason I use this example is because it's very similar to example 3.1, but it's just for the perpetual, just so that you can see the main differences between the two. As I've said before, I feel that if your foundation is correct, if you do the other examples after that, things will make sense. But if we try do more complex things without having foundation correctly, everything is going to fall apart. So even if after this class you are still not sure, please try and get the foundation correct by understanding the examples we did, and then only move on to more complex examples. So the information for inventory using the perpetual inventory system is as follows. So it has exactly actually the same amount of information, right? It says the inventory balance at the beginning of the year was 20,000 at hand. So that is exactly what we also had here in our other inventory example. So we've got our 20,000 coming from prior period. Then inventory was purchased by the business on cash for 10,000. So this is where it differs. With our periodic inventory system, now we started to look at our purchases account and we didn't adjust our inventory account. But in this example, we actually adjust our inventory account. So we make our inventory account more with inventory purchase. So we have 10,000 of inventory purchased for cash. And if we pay something, we make our cash less, we are crediting it on the credit side. Cassie gives. So our cash account is being decreased with the 10,000 and our inventory account is being increased. And we've got our double entry system. Whereas when we did the periodic, we have the same entry for cash. Our cash account decreased. We also debited an account, but it wasn't inventory. We debited purchases. Then we have inventory of 15,000 that was purchased by the business on credit, right? So again, we have a purchases. We're making our inventory more. We are debiting our asset and we aren't crediting our cash. We didn't pay for this with cash. We paid for it on credit. We're not going to pay for it now. We're paying for it later by using an account. And we are increasing our trade and other payables, increasing a liability. Similar to what we did here, we also increased our liability, but we didn't debit our inventory account. We debited our purchases account. Now, for the perpetual one, we are debiting our inventory account. You might ask why, and this is because for the perpetual system, the inventory balance is always known continuously, like checkers 360/60. They know what their stock is, right? That's why they were immediately debiting and crediting the inventory account. So then when we sell these things, we know our cost of sales. We are showing our cost of sales immediately. I'm left behind is kicking me out. It means I'll go through the recording. Okay. Thanks, Chantal. Apologies that you are having technical issues. It's really frustrating, I know. So if we've got, now we are going to when we sold some inventory, right? So number 4, inventory of 22,000 was sold by the business for cash. So again, our cash increases, right? The same as on this side. Our cash increased with the 22,000, but then we also increased our sales, 22,000. and that's what we're going to do here as well. So we debited our cash, made it more, it's an asset, and we credited our cash, right? We made it more, it's an asset. Then we have inventory, cost of sales, expense, right? And how on earth are you going to tell me, how did I get to that cost of sales? How do I know what my cost of sales is? So first of all, just to break it down a little bit, cost of sales is what it cost us, right? So if we look at, we've got our purchases amount, right? So what did it cost us to purchase it? And we've got our selling price. And then we also have to have the cost of the sale, what it cost us, and the difference between our cost of sale, what it actually costs us. I think you'll understand now, Zulani. Just give me a minute. It's a lot to take in, but I'm going to break the example down further. So when we have our cost of sales and we deduct that from our selling price, we get our profit, the difference between the two. So if we look here, for example, we've got our cost price, right, equals, this is the formula, right, equals your selling price times 100 divided by your markup percentage. That in itself can get you also a little bit lost, right? So, if you say, for example, that your markup percentage is 20%, well, I will ask that people please mute themselves unless they have a question. Thank you. So if you say that your markup percentage is 20% and your cost price is 12,000, sorry, and your cost price 12,000 is given, you will use the following formula. So these are two different examples, but just to break it down a bit further for you and make it easier to understand, you always take what you have, right? What do you have? So if they gave you, for example, cost of sales, cost of sales, they gave you as being 10,000 Rand, right? Now you want to work out what do you want over what do you have. So cost of sales, your cost is always your 100, right? It's always 100% of whatever is costing you. But if somebody tells you you've got a markup, right? They want to make a profit markup on the sale of 20%, right? And your cost of sales amount is 10,000, then you've got your cost of sales. You want to work out what your profit is going to be, right? What should your selling price be if you want to make a 20% markup on this cost of sales? So you take your 10,000, which is what do you have? You've got your cost of sales times what do you want? You want to know your 120. How do I get to the 120? You want to know what your selling price should be. If you take your 100, which is your cost of sales, and you take your 20, what is what you want to add to that you want your profit to be. So you want to know what your selling price should be, right? What should your selling price be? And you divide that over what do you have? Okay. Meaning, what do you have at the moment? You've got your 100, right? Which is your cost of sales, which is your 10,000. So what you would do is you would take your 10,000 cost of sales, if you want to work out what your selling price would be, and you multiply that by what you want, your selling price, which is the 100 plus the 120, divided by what do you have? Your 100. 10,000 times 120 divided by 100. So you would get that your sales amount needs to be 12,000. If, for example, you had your 12,000 as your sales, just to illustrate this for you further, if you had your sales of 12,000, but now you want to work out what your cost price should be, right? So you've got your sales, which is your Sales is always your cost of sales plus your markup, in this case being 120. So you've got your sales amount, and now you want to multiply it by what do you want? You want to know what your cost of sales should be to get you that markup. So you take your, yes, I can enlarge it. Let me just try. Is that better? Hope so. If not, shout. So if you've got, maybe we go through this one again. So you always take what you have and you multiply that with what you want over what you have, right? And this is in terms of 100, 120 as a percentage. If you look at any cost price ever, any markup ever, your cost of sales or your cost is always at 100. Your markup or whatever percentage you want to make is added on top of your cost to give you what your sales will be. If you wanted to make a profit of 50%, this would change. Your cost would always be 100. You add the 50 markup, and then your sales is also always 150. Is it still small, honestly? Because I'm at 200%. Is it still small for everybody? Okay.
Lynn-Marie,
Yeah,
if you don't mind me coming in,
sure.
students, you can, if you look at the bottom left-hand side, you will see a small minus and plus sign. If you click on the plus sign, it will enlarge on your side as well.
Thanks, Antoinette.
That's usually the best way to go about it. So just look, it's at the bottom left in the corner. I don't know, you will see Lynn-Marie's name, Lynn, and her surname, and then a minus and a plus. Then you can just click on the plus sign. I hope that helps.
Thanks, Antoinette. Very useful. It seems everybody can see now, though. Yes. Question? Or was that a thumbs up? Okay. So this will always change, right? This can be however you want. Great. So you, whatever your markup is, whatever the profit is you want to make, you add that on top of your 100, and you get what your sales is. And if you use this formula, I believe it will help. And we can try this formula now further in our example, right? So in this example, they told us that the markup on inventory is 25%. So after what I just tried to illustrate, we've got our cost is always 100. In this case, they say the markup is 25. So our selling price will always be the 100 plus the 25, 125. So if we're trying to work out what our cost of sales is on a sale of 22,000, if we go back to my example of what do we have? In this case, we've got 22,000, which is our sales amount, right? Which is our 125, if we put it that way. And now we want to work out what our cost of sales amount is, right? So we've got our 22,000. Now we're multiplying it by what do we want? We want our cost of sales, which is always our 100, divided by what do we have? We've got our 125, which is our selling price. Yeah, our selling price is 125. So if we are working out our cost of sales amount, we say we've got our sales times 100. What do we want? We want the cost over what do we have? Our selling price, 125. And that gives us our cost price, or our cost of sales for the 22,000 is 17,600. And if we go here, how do we account for that? We are bringing into our cost of sales, which is an expense account. If we go back here, expenses are increased on the debit side. So if we bring in that 17,600, it debits it on this side for us. And we also take it to our inventory, right? Because this was the purchases. We added this, we made our balance more. But when we sell something, we are decreasing, we're making our inventory less, right? And with what are we making it less? With the cost price. So basically with our inventory amount of the sale. So we again have a double entry principle. We are making our inventory less with whatever it cost us to make that inventory or to purchase that inventory. Similarly, when we sell the 26,000 on credit, so not for cash, but on credit, we have the same journal entry or the same formula to get us to be able to process our journal entry. We take our 26,000, which is what we have, our selling price, times by what do we want? We want our cost price divided by what we have, which is our selling price, 100 and 125, and that gives us our cost. And that's worked out the same way as what we worked out the previous cost price. Once we have our cost price worked out, we are again debiting our cost of sales, making that expense more because we sold more, but our expense is also more in terms of that sale. And we are again decreasing our inventory because this side increases our inventory balance. And when we sell things, we also have to make our inventory balance less. This decrease in your inventory account does not happen with the periodic inventory system. At the end of the year, we do this cost of sales account to get our cost of sales balance, which we then transfer. That is the main difference between the two. We also had this trade receivable, which I don't seem to have marked the color here. Yes, when you sell on credit, that's what I was just getting to. Thanks, Ash. So number 5, when we sell this 26,000 on credit, we've already done this cost of sales portion of it, right? How we work that out, but I haven't yet dealt with how we show the credit amount, right? Increasing our sales with the 26. So here we have to increase our sales with the 26 amount. And we have to, because it's sold on credit, we are also trading other receivables account, which is a asset account, making it more on the debit side. So when we sell it on credit, we are increasing our asset. We'll get it later, the debtor, and we are increasing our sales. This entry is exactly the same as here on our periodic system. We increased our asset and we increased our sales. So the main difference between the two is our cost of sales account, how that's accounted for. Our purchases account is only with the periodic system, and our inventory account is adjusted the whole time with the perpetual inventory system. And it's in the perpetual inventory system that we work out this markup and we calculate our cost of sales as we go along for each sale. Any questions? Okay. So I want to sort of stop here because I feel that if you've got these this basic 2 examples correct and you work through the other examples in the study guide, I feel that you will have a really good understanding of inventory. They just add a little bit here and there, but you would have already now had a good understanding. Thanks, Antoinette. I was going to just send it. So Antoinette has kindly put in the chat for us a sort of questionnaire that we would ask you to just fill out. It helps the lecturers especially and us as presenters to know how we can improve. Please just do take a few minutes. I know it's probably the last thing you want to do at the end of your day. And whilst you are looking at that, I maybe just want to mention one more thing, and that is that there are two valuation methods. Yeah, sorry. Do you have a question?
Yeah, it's not necessarily a question. I think
Yeah.
just a brief feedback. You know, when we done the first example, I was following, and then this one of
Perpetual.
perpetual, it's kind of like complicated, and for the first time, I mean, I'm not an accounting professional, so I was just like doing. But next time, I think when we start, we'll just maybe start with this one so that we can comprehend what we had. But thank you very much. I think the presentation was good.
You're welcome, and thanks for the feedback. I think inventory in itself is complex, especially if you are looking at two different systems, and also if you don't have a background of accounting, it really is complex. And I will also share this Excel with Antoinette. Then we can share that with yourselves. So hopefully they can help a little bit. If you maybe then rework through the perpetual example. So what is actually the difference between the two systems, right? So what we said right in the beginning is the periodic inventory system doesn't have an accurate record of inventory all the time. It needs a stock take at the end of the year. Whereas the perpetual inventory system has a continuous record of inventory count. And the perpetual inventory system, for that reason, adjusts the inventory account as you go along. And for the reason that the periodic inventory system doesn't have a record of the inventory all the time, it uses this purchases account. And the main difference is, as we mentioned before, that the periodic inventory system uses a purchases account, whereas the perpetual one adjust the inventory account as we go along. I don't know if that helps you. I just also wanted to mention the two valuation methods in inventory from the study guide. And it's important that there's a first in, first out method and a weighted average method. But for the purposes of all of your tests or exams assignments, you will only be tested on the first in, first out method. But again, this is a mere small calculation. If you understand the difference between periodic and perpetual inventory system, I feel that the rest is easier to grasp. Okay. Anything from somebody else, or Antoinette from your side?
From my side only, we hope to have the recording either this afternoon or tomorrow, on your FIC 1503 site, the main module site, under announcements. We will post the link to a YouTube channel that was created for us. So just please be patient. Yeah, there's a lot of editing also sometimes they need to do. And then also, thank you so much, Lynn-Marie, for your class that you presented. I think the students really appreciate it as I do. And yes, I think this is a difficult topic, but you really explained it in a very simple way that I think they benefited from a lot. So yes, please, students, complete that quick survey. It will also benefit Lynn-Marie and, of course, from our side as well. Thank you.
Thanks, Antoinette, and thanks for also being sort of organizing all of this for everyone. And then I would ask if you can also kindly stop the recording because I can't do that. And thanks everyone for joining, and best of luck for